Hello, and welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. Today is September 4th, 2021. It is 2:13 p.m. Eastern Standard Time. In today's episode, I want to start talking about something that occurred to me recently, and I even mentioned it to my business partner that I wish this was a bit of advice that was given to me at the beginning of the year. Well, in preparation for this podcast, I was looking at some longer term charts of the S&P, and the advice that I wished someone would have given me at the beginning of the year would have worked at the beginning of last year, the year before that, going back to about the beginning of 2009. The advice I'm referring to would be simply do not bet against this market. Year-to-date passive returns in the S&P 500 are about 20%. The NASDAQ has returned similar levels. But looking at longer term charts, back to the beginning of 2009, you see the S&P 500 in particular steadily marching higher with periodic corrections, but the overall direction has been higher. The market reaction to COVID is clearly noticeable on a longer term chart where you see a sharp drop in the value of the S&P, followed by a quick recovery, and then the market has continued to accelerate higher. And compared to pre-COVID, the growth rate is even faster now. I've always tried to hold a small passive portfolio, and I paired that with active trading of options on equities, and some of my worst trades have been shorting this market this year, while the passive side has just been steadily appreciating. With that in mind, I've been looking at the returns on the active side of the portfolio, and it occurred to me that if I had simply followed a long-only approach on the active trading side of the portfolio, my returns would be much better. So every week going into the week, I should bet that the market goes higher. Looking back on the past year, the past several years of trading, I would have been right more times than I would have been wrong. Of course, there would have been those weeks where the market was down, but compared to the number of weeks where the market was up, the returns on the trade would have been completely asymmetric, all skewed to the upside. I'm saying this to say that because of the returns that I've noticed on the passive side, which is typically a smaller part of the portfolio, I've had to reevaluate the way that I think about it. The conclusion that I came to was that with the market trending the way it has been, by allocating more to the passive side, I can generate more consistent beta and still use the active side to generate alpha when the market is presenting opportunities for breakouts or accelerations higher. So basically, trade the market in one direction, and whenever I see a price pattern or a setup that's hinting towards a move higher, being that is the bias of the market, I can lean in with the derivatives, add a little bit of leverage, and try to get a multiple on the beta with some alpha. From an economic standpoint, it is worth mentioning that where we are today is not where we were a year ago or where we were in the years leading up to today. The economy is in a much sounder place, and with the massive amounts of monetary stimulus that has been pumped over the years, paired with the massive amount of fiscal stimulus that is being pumped and will be pumped into the US and global economy over the next few years, the economic outlook looks a little bit better than it did several years ago. That could mean, from a finance side, that stock markets have a fundamental reason to be rising. However, or as they like to say in economics, on the other hand, with better growth, there comes an increased chance that the monetary stimulus will be withdrawn. And because a lot, not all, but a lot of the growth that we've seen over the past decade in equity markets can be attributed to monetary stimulus and quantitative easing. So if the Federal Reserve and other central banks are at the point where they're considering taking the accommodation off the table, that could serve to depress stock valuations, stock prices, and the rate of growth that you've been seeing in equity prices. Now, the historical bias on equities, in particular US equities, has been up. So there's that on the side of investors. And there's nothing that says that the market, whether rational or not, can't keep going higher at this pace. Can this continue forever? More than likely not. Will it continue for a long time? It possibly could. How long of a time? I don't know, and I'm pretty sure no one really does. But in the meantime, from a trading standpoint, you have a macro trend with macroeconomic support behind it. You have all the technical indications of the price moving higher until something changes fundamentally that results in a dramatic change in sentiment in equity markets across the board. It's safe to assume that the stock market from where it is now will only continue higher. After all, if COVID couldn't stop it or slow it down, what will? It's been a couple weeks since I last recorded a podcast. In that time, I haven't been trading a lot of different instruments, but I have been fairly active in the ones that I have been trading. In the intro part of the podcast, I talked a little bit about the S&P 500. I like to get exposure to that index through the SPY ETFs. I trade options on that. Gold is another one that I like to get exposure to because of its correlation relationship with the dollar, which fluctuates from time to time. I get that exposure with the GLD ETF. I trade options on that. I've been dabbling in spot forex as well. I had a short-term position in the New Zealand dollar US dollar exchange rate. I closed that position at a small loss. Thought I saw a setup in the US dollar Canadian dollar exchange rate. Ended up closing that position at a small loss as well. So that let me know that I needed to take a closer look at my dollar chart. My exposure to gold that I traded through the GLD ETF was a loss, which also hinted to me that I needed to take a closer look at my dollar index charts, but also the correlation relationship between gold and the dollar. What I've noticed recently is that relationship has been in flux. On the short term, the correlation has been oscillating back and forth from positive to negative, but most of the time staying close to the zero line, which can be interpreted as no correlation. So I was looking at my dollar charts, making interpretations about my gold chart, and making the rookie mistake of ignoring feedback from my gold chart based on my interpretation of my dollar chart. That interpretation was missing something. Something was happening in the dollar that I wasn't picking up on. Because of me not being aware of what was really happening in the market for the dollar, I lost money on the US dollar, Canadian dollar exchange rate, as well as the New Zealand dollar, US dollar exchange rate, and misinterpreted my gold chart, lost money on my options on GLD as well. My trading on the SPY has been successful. I've had a good run recently. Like I said, it occurred to me that I shouldn't be betting against the market. So I started increasing my passive holdings, and at the same time keeping in mind that the S&P 500 has a upward bias when looking for trade setups. I've been looking for breakouts. I've been finding breakouts, and I've been using call verticals to capitalize on those breakouts. I use my Fibonacci extensions to help me set my targets. And of course, I try to get strike prices that aren't too close to any of the support and resistance levels highlighted by the Fibonacci's, just to make sure that as the price does seek out support or resistance, it clears my strikes on my verticals. And that's been fairly successful. The last couple of Fridays, I've had verticals expire in the money, and actually the prices cleared the verticals, so they're being closed out at maximum profit potential. I currently have one more open. It expires on Wednesday, but depending on how the market trades for the first half of the week, I may look to set up another call vertical on the SPY expiring on Friday if I can find a good entry point with a setup hinting towards a breakout higher. If I miss the trade, the passive side of the portfolio appreciates as the market moves higher, and I get to capture that. If I do get the trade, the passive side still appreciates as the market moves higher, and I get to leverage up my returns with the active side. On the flip side, if the market pulls back, I don't enter on the active side, and I get to keep those premiums. And when the passive side pulls back, I get opportunities to increase my exposure with better pricing. The last thing in the trade book I wanted to talk about was my position in BLOK. So I started buying into this ETF a couple months back. When I first started buying, Bitcoin was roughly around 50,000. I took the dollar cost averaging approach because I knew what position size I wanted to get to. I bought into the ETF as the price on Bitcoin fell from 50,000 to a little bit over 30,000. And now that Bitcoin is back at 50,000, and last I checked, I think it was above 50,000. But now that it's back up to that level, the position is profitable and open. I like that ETF because I get the exposure to the blockchain universe, highly correlated to Bitcoin, of course, but with the kind of upside that Bitcoin does present, I do think this ETF is a fairly comfortable way for me to participate in the upside of Bitcoin without necessarily taking on some of the esoteric risks of investing in the cryptocurrency directly, or having to commit insane amounts of money on margin for futures contracts. So I mentioned earlier that I was looking at the dollar chart and ignoring signs on the gold chart because I assumed that the correlation was inverse between the two, not really stopping to quantify the correlation between the two instruments by actually looking at the study. And that's a mistake that I still make from time to time. I get overly confident and I start skipping steps. Something as simple as checking the correlation between the two instruments versus assuming that the relationship hasn't changed since the last time that I looked at it, which obviously it had. But looking at the dollar, the price has been gently sloping lower all week. That's reflected in the regression curve ribbon, which is traveling lower, and the price is oscillating around the ribbon as it travels lower too. The pivot indicators above the price signaling resistance. My linear regression curves measuring momentum and trend are both negative and getting more negative. So overall, in the short term, the dashboard is signaling a move lower in the dollar. The 10-year treasury isn't displaying a very clear sense of direction. Throughout the week, the regression curve ribbon has been oscillating sideways. The price has been oscillating around the ribbon, and the pivot indicator has been oscillating around the price. So basically, everything has been moving sideways. Similarly, my linear regression slopes measuring trend and momentum spent most of the week oscillating around or hovering below or above the zero line, further indicating sideways movement. From a trading standpoint, there are some option strategies. Iron condors are a strategy that I would use in a situation like this where you see a market with clearly defined highs and lows, trading sideways. You've got technical indicators that are confirming the sideways movement. You can use an iron condor, for instance, to collect premiums above and below the support and resistance levels of the price action, as long as the price stays within that range. So in a scenario like this, of course, you'd have to closely monitor your candle patterns, looking for signs of a breakout, because your technical indicators are not going to forecast it as clearly as they are going to confirm it after it has already begun. So in that case, you're looking for the price to continue doing what it's doing. You're going to want to zoom in, try to identify some kind of price pattern, and look for that price pattern to repeat. Market prices tend to be fractal, which means that the same patterns you see on small scales just repeat over and over again to create a similar pattern on a larger time frame. Once you see a break in that pattern, that break is going to start repeating over and over again, and it's going to create a break in a bigger time frame. So by zooming in and looking for changes in the price action itself, the price patterns, you can have a bit of a clear idea when to get in and out of a trade like that. And again, it's not foolproof because there are always exogenous shocks that come from outside the market that moves the market. So something in the news, for instance. But barring something like that, you can trade sideways prices using options. It's just a matter of what strategy you want to approach. In this case, you would look to collect premiums. and benefit from the price not moving outside of a tight range. Gold was presenting a similar profile for most of the week. The price was oscillating sideways. The regression curve ribbon was doing the same thing. Linear regression slopes measuring trend and momentum were both hovering above or below their zero lines, and the pivot indicator was oscillating around the price, just like we saw with the 10-year Treasury. Unlike with the 10-year Treasury, on Friday, gold saw a bit of a run-up. So we saw a breakout higher, and the price settled above the range where it was trading throughout most of the week. In that case, this is what you would be trying to forecast by looking at price patterns on a smaller time frame that breakout above the range. An iron condor setup would have been profitable as the price traded most of the week within a range, but on Friday, the price breaking out of that range would have put one of your legs in your condor in the negative. So while with the 10-year Treasury there was no clear sense of direction from the dashboard, because of the move on Friday in gold, we see a move higher in the linear regression slopes measuring both trend and momentum. It's a little bit too early to call it on the linear regression slope and the pivot indicator, because the pivot indicator had spent most of the week oscillating around the price. So has the linear regression curve ribbon. But in the upcoming sessions, if we see the price establishing support above the ribbon and then taking a leg higher and dragging that pivot indicator up with it, then we can confirm that the price is accelerating higher, which should also be reflected in the linear regression slopes that measure both trend and momentum. So going into the first half of the week, I will be looking to see if gold establishes a support above a level that it previously was using as resistance. That to me would confirm a move higher in gold. At that point, I'm looking for a breakout for the next leg higher. Crude oil had a similar profile on the week. It oscillated sideways for most of the week, except it had its breakout on Thursday. So we see the pivot indicator oscillating around the price, the linear regression curve ribbon oscillating around the price, and the linear regression slopes measuring trend and momentum were either oscillating around the zero line or spent a lot of the week hovering either above or below the zero line. We get into late Thursday and we get a pop up in oil. So again, up until we get that break in the sideways movement, there was an opportunity to use a iron condor strategy to capture premiums on both sides of the range as long as the price stayed within that range. Well, we saw the breakout on Thursday, and trading into Friday, we see the price then settle back above the range that it traded before and is now using a old resistance level as new support. Like with gold, if the support level holds, then I will be looking for price patterns that hint towards a breakout, and I will be looking to trade the breakout of the next leg higher in crude oil. If the support doesn't hold, then what we may be looking at is crude oil just widening the channel within which it trades sideways. So if the support does not hold, then more than likely the price falls back down to the lower bound of the channel that it was previously trading, and then from there reverses and consolidates back towards the top of the channel. The S&P 500 spent most of the week gently sloping higher. The regression curve ribbon oscillated higher, and the price oscillated around the ribbon higher. The pivot indicator spent most of the week under the price, signaling support. And my linear regression slopes measuring trend and momentum spent most of the week hovering above the zero line. So that signals the price is moving higher. Not very quickly, but it's moving higher. With the thought occurring to me that I shouldn't be betting against this market, my anticipation is the price continues to gently slope higher until a breakout pattern forms, and then we get a sharp move higher and then back into a consolidation pattern. So overall, in the upcoming week, the dollar should be presenting weakness. The 10-year treasury will more than likely continue trading sideways, even though with its correlation to the dollar, it may have a tendency to move lower. Gold is presenting a breakout pattern, particularly within the last few trading sessions. Depending on how the price finds support, it could be highlighting a bull flag pattern, which is a setup for a breakout and a move higher. Crude oil, from a fundamental standpoint, I think is going lower, but the crude oil market could have other ideas. From the standpoint of the dashboard, if crude oil can find support around the level where it is right now, then we can see a move higher with a breakout from a pattern similar to what we see in gold. The S&P 500, I think, keeps moving higher in a slow, methodical fashion with periodic breakouts if there's nothing fundamental that changes with the U.S. economy, with monetary policy, or with fiscal policy. I'm looking at the dollar index bump up against a linear regression curve ribbon, which I think it uses as resistance at this level. A move lower from here will more than likely be to 89.50. The dollar index has gotten to this price level once already this year. It spent some time there last year. In early 2018, it spent some time there. So this is a level that the dollar index has consolidated at before. And with the amount of resistance that it is demonstrating currently, it looks like the price can drop back to find support at that level. That being said, the dollar drops, we should see commodities rise. We may also see interest rates rise in the United States. So long-term yields like 10-year treasury yields. For context, however, the dollar index is currently at 92.11, and we're looking for a drop down to about 89.50. So in the grand scheme of things, not a very big move, but it's the dollar index. There are derivatives, lots of leverage, so a relatively small move in an index can result in a lot of money made or lost, depending on how you structure your exposure. The S&P 500 looks to be on track for the 4,900 target. For reference, it recently closed at 45.50. It may not get there by the end of this year, but then again it might. Looking at a Fibonacci extension, started the measure at the low made in February 2009, took the peak to February 2020, did the trough in March 2020 with the low created by COVID, and now the price is extending well above its 78.6. It consolidated at the 50, broke through, consolidated at the 61.8, broke through, never really consolidated at the 78, which would be about 43.25. So maybe towards the end of the year, we get a bit of consolidation back to the 78.6, or maybe the price just continues to accelerate higher onto the 4,900 level. In the long term, I think gold is going lower because in the long term, I think the dollar is going higher. But of course, in the short term, their correlations do change. Looking at the longer term chart, gold can rise to about 1900, where it will find resistance at a level that it's consolidated at before. And from there, it can drop back down to the bottom of the range of about 1675, which is a range it's been consolidating in for all of 2021. So we see a tight consolidation range setting up on a long-term chart of gold, similar to what we see in the long-term chart on the dollar, where we see a tight consolidation range setting up. So over the long term, those two asset classes are strongly negatively correlated. But like I said, in the short term, in the interim, that relationship can fluctuate and it can change back and forth from positive to negative, or from time to time, the two asset classes just have no correlation whatsoever. Then we have the 10-year Treasury, which is also encountering resistance with a linear regression curve ribbon. The price is setting up what looks like a bear flag pattern, which indicates a breakout lower in price. The closest point of support is at the 23.6 on the Fibonacci retracement I have overlaying the price. And for reference, on Friday, the price closed at 133.5 versus the closest support level being at 132.25. But if the pattern holds and there is a breakout of the bear flag pattern, then the breakout would coincide with the price breaking through that support level, at which point the price would seek the next closest support level at about 128. Now that's a pretty big drop in price in the 10-year Treasury, and it would take it back to interest rates that we haven't seen since January 2020, just before COVID. With crude oil, I'm looking at a longer term chart and it has hit up against resistance, and it looks like the resistance is holding. The last time crude oil was at these prices was most of 2018. It couldn't get above it. The price dropped. Of course, COVID took it down to extreme lows. On my chart, I've got a low of $6.50 per barrel at the beginning of the COVID lockdowns. And now the price is back up to those levels that we saw back in 2018. If it can't break above it, then the next level of support below would be around $56 a barrel. Past that, we're looking at $35 a barrel on oil. So from the standpoint of my longer term charts, it does look like oil is in for a bit of selling pressure. Similar can be said for gold, and I think those do correspond with rising levels of the dollar. 10-year Treasury looks like it can be facing some long-term selling pressure as well, which hints towards more normal monetary policy. As inflation expectations are rising, so should long-term interest rates, as well as short-term interest rates once the Fed starts unwinding their ultra-accommodative monetary policy. So, from a long-term perspective, we may tend to see an appreciation in the dollar, as the U.S. economy will clearly be the winner of the race to the top in terms of fiscal stimulus and the benefit. This will result in foreign demand for dollar and dollar denominated assets. The higher yields and decreased Fed buying will push down the price of 10-year treasuries and push up interest rates, which would steepen the yield curve, which is positive. It signals the expectation of growth. And most importantly, as a source of inflation and as a measure of inflation, gold and crude oil, respectively, are both, from a technical standpoint, demonstrating signs of weakness. So, weakness in the price of oil keeps down commodity prices, tempers inflation expectations, as well as weakness in gold as a gauge of inflation expectations will also serve to positively reinforce the idea that inflation is transitory and under control by the central banks. Lastly, we have the S&P 500, which I think will continue to march higher as foreign investors commit capital by first buying dollars to buy U.S. equities, as they see U.S. companies benefiting from the fiscal stimulus and the economic growth that will ensue. And on that note, we'll wrap things up for today. Today we talked about technical analysis. We talked about chart patterns, candle patterns, technical indicators. These are all things that I think are immensely important to trading. Whether you're a new trader learning for the first time, you're an experienced trader with a system that you evaluate periodically, understanding, internalizing, and utilizing technical analysis makes a world of difference. Through Run the Numbers University, you too can learn technical analysis from a market expert. You can learn to use technical analysis to enhance your understanding of how markets work, how asset classes relate to each other, and to improve your decision making and timing when it comes to trading. So go to my website right now, type in your browser www.rtn.education. That's rtn.edu.catation. Hit enter, and you will be able to view and purchase online courses in technical analysis and charting so that you can improve your returns like the pros. For the more experienced traders that need a little bit of coaching, you can visit my website, runthenumbers.biz. So type in your browser www.runthenumbers.biz, hit enter, and there you can look at my consulting services that range from portfolio construction to portfolio management. And on that note, this is your neighborhood financial economist, Katie Mark. When in doubt, take profits.